Good evening, friends. On the basis of the functions, we can classify the ratios into four broader categories. First one is the liquidity ratio. This liquidity ratio will help you to understand how capable you are to meet your immediate requirements. For example, paying the bills, paying the sundry debtors, paying the rent, paying the interest, everything, how you are prepared. How you are prepared. This will show you that result. The second major classification is long-term solvency ratios. This long-term solvency ratio is debt to equity or debt to capital. Then the activity ratios are asset management ratios. This is how you are utilizing your inventories, how much fast that your stocks are being rotated, how much fast your working capital is being turned over, how your payables are turned over. These things will help you to understand so many things. Literally saying that this ratio analysis is maybe the eighth wonder. Only just by seeing the profit and loss account or by seeing the balance sheet, you cannot come to a conclusion about the company's performance, their commitment to finance, commitment to payment, everything. But once you use these ratios for analyzing the company, you will get an in-depth knowledge about the company's preparedness, financial preparedness. Then the profitability ratios. Now we will discuss one by one. Of this current ratio is the biggest ratio, very important ratio as far as the ratios are concerned. This will give you a clear-cut understanding. See, this is the these are all the things which are included in the current assets: cash in hand, cash in bank, then marketable securities, that securities which can be encashed within a period of 1 year, then short term investment. Here all the things which are encashable within a year is taken as current assets. Then bills receivable, sundry debtors, inventories, work in progress, and prepaid expenses. Similarly, on the liability side, your outstandings, your bills payable, your sundry creditors, your short-term advances, your income tax payable, your dividends payable, then bank overdraft, if any, will be included. In this analysis, lot of window dressings are happening. You have to understand it very clearly. How they will interpret is, they can manipulate the cash in hand. Cash in bank they cannot manipulate because it will be in the bank statement. You cannot manipulate it. Or sometime what they will do is, they will deposit from owner's money or some from borrowings, and they will not show it on the closing day, and that money will be deposited into the bank account. In that way also they can boost up the closing balance of the bank account. You have to take care of that. So, and another thing is the cash in hand. Cash in hand is always given by the company itself. Then marketable securities. The marketable securities which can be sold within a year. So here also the manipulation will come. They may be purchased some stocks at 1000 rupees, and the present market price may be 200 rupees. If they show it at a purchase price, it will be a manipulation. Then bills receivables. Bills receivables. In this, what will they? What is bills receivable? Bills receivable is if we receive some post-dated checks from our debtors, that will be in bills receivable. And sundry debtors. Sundry debtors. Inventories. In this, what they will do is some outdated stocks. Some outdated stocks will be in store, or the stocks may be purchased at a higher price. That will be shown in that inventories. In that way, that manipulation will also be included. So you should be very careful while analyzing it. Only then you will get a clear-cut interpretation. So the current ratio, the formula is current assets minus current liabilities. This ratio is always preferable if it is 2:1. That means your assets should be 2 and your liabilities should be 1. That is 50% of liabilities you can have compared with your assets. If you have 1 lakh rupees as asset, current asset, you can have a liability of current liability of 50,000 rupees. This is the standard accepted formula, right? Now we will see this sum. See the stock. Our formula is current assets divided by current liabilities. What are all the current assets? The stock in hand, 60,000 rupees. You have to add it. Then sundry debtors, 20,000 rupees. Cash balance, 20,000 rupees. Bills receivable, 30,000. Prepaid expenses, 10,000. Land and building, 1 lakh. Goodwill, 50,000. Of this, which are all the current assets? First, you have to identify what are all the current assets. Current asset is stock. Stock, sundry debtors, cash balance, bills receivable, prepaid expenses. Of this, land and building and goodwill will not come under the category of current assets. See this formula? Current asset is 60,000. What is 60,000? Your stock. Then 70,000. Okay. Sundry debtor. Sundry debtors. This is 70,000. Then cash balance 20,000 rupees. Cash balance 20,000 rupees. Then bills receivable 30,000 rupees. Prepaid expenses 10,000 rupees. Up to this we have included. We have not included land and building and goodwill because it will not come under the category current assets. So this total is 1,90,000 rupees. The current assets total is 1,90,000 rupees. Then what is your current liabilities? Current liability is sundry creditors. See, sundry creditors 20,000 rupees. Then bills payable 15,000. Tax payable 80,000. Outstanding 7,000. Then bank overdraft 25,000. In this we have removed the debentures. Removed the debentures because debenture is a long term liability, not the short term liability. So we have removed that, right? Now the current ratio is 1,90,000 divided by 85,000. So 2:1. 2. Now it is 2.24. Correct. It is more than 2. So we can conclude that the company's current asset is current ratio is well and good. It can serve the immediate liabilities in a better manner. This is how the banks or the lenders or some financial institution will take into account. If you are going to join in a bank or a non-banking finance companies, you have to judge your customers only in this given broader parameters. Even if you are working as an accountant in a company, you have to calculate these ratios in a proper way. Only then you can understand how your company is capable of paying their current liabilities. Otherwise, you will meet cash shortages every now and then. In order to avoid this, you have to understand this very well. Here you have to calculate everything manually. If you are utilizing Tally software, whether it is a Tally ERP9 or Prime, any software, you can get this report in a single command. All these features are included in the Tally software. Right? We will see the next ratios in the next video. Thank you.